Here's the hard truth that no one wants to admit on camera. The housing market is not broken simply because prices are high. It's broken because the monthly payments required to live in the average home has outrun the average household by a mile. If you've run the numbers and you felt sick at the payment screen, you're not crazy. I'm going to show you why this is happening, where the stress is building, and who's most at risk, and the specific playbook that I would use if I had to buy or sell a home in the next 12 months or so. By the end, you'll know exactly how to avoid a six-figure mistake. Let's start with the only number that really matters to most families, the monthly payment. Real estate used to be priced by sticker price. Today it's priced by the payment. When rates fell, buyers could stretch for more house because the payment it didn't change that much. And when rates rose, buyers, they didn't get cheaper houses because inventory shrank even faster than demand. So prices stalled instead of crashing and payments exploded. Now that simple mismatch is why affordability feels worse than any chart on social media. Sales volume tells the story. When fewer homes are selling than you would expect for a country that's richer and older than it was 20 years ago, that means the system is gummed up. Fewer transactions signal stress building under the surface. Sellers can't hang on forever. Some will relocate, divorce, retire, face job loss. When sales slow and time on market rises, the next stage is price discovery, and that's never comfortable. Affordability is the real choke point. Compare a median household income to the payment on a median priced home with taxes, insurance, and maintenance. For many markets, the gap is hundreds of dollars per month in favor of renting. And that's before you count the opportunity cost of a large down payment. If it costs you an extra $6,000 or $10,000 per year to own the same roof that you could rent, the numbers just don't pencil unless you're staying for a really long time or you have a unique reason to own that specific property. There's also a silent reason that rent looks more attractive. Owners with 2 or 3% mortgages can rent their homes below what a new buyer would need to break even. Now, that compresses rents in many neighborhoods, and it makes purchasing look even less attractive. The result is a widening gap between the cost to own and the cost to rent. And that gap, it doesn't close overnight. Builders add another twist. In many areas, new homes are competing head-to-head with existing homes. Builders have levers that existing homeowners do not. They can buy down rates. They can throw in closing costs or drop prices across an entire subdivision in one email to brokers. When new construction is comparable or even cheaper on a monthly basis, existing listings, they must respond. And that's why you see price cuts cluster around new home communities. Incentives, they're not free. They're a signal that the price without the incentive is too high for the current buyer pool. Inventories, it's not just a number. It's a story about who has to sell, who wants to sell. The locked-in owner with a low rate is a reluctant seller. The relocating owner is a motivated seller. The builder with carrying costs is a very motivated seller. The short-term rental host with rising insurance, rising cleaning fees, and a falling occupancy is a motivated seller. The longer rates stay elevated, the more life events force action from people who prefer to wait. And that's where true price discovery tends to happen. Before we go any deeper, if you found any value in this video or you've learned something new so far, please give it a like, subscribe, and leave a comment down below telling me whether buying or renting is cheaper in your city right now. That real-world data from you helps everyone here make better decisions. And it tells the YouTube robot beep boop to show this video to more people. Anyway, let's talk about the idea of what a small rate cut might do to the market. Mortgage rates are tied more to long-term bond yields and inflation expectations, like the 10-year treasury, than the short-term Fed funds rate, which is the Fed rate. That's what they do cuts on. A quarter point on the short end, it doesn't guarantee lower mortgage rates. If investors think inflation will stick around, mortgage rates can stay stubbornly high, even as the Fed trims. Mortgage rates actually went up last time the Fed cut. Now, counting on a refinance to bail out a bad purchase price, it's not a plan. It's a hope. Now, what about the claim that there's a permanent housing shortage? There's a shortage of homes that people can afford at today's payments. That's not the same as a shortage of boxes with roofs. When you look closer, you find entire segments that are oversupplied at the current price point. The mismatch between builders and what they created during the easy money era, during the pandemic, and what typical households can carry today. The solution is not a magical policy that makes payments low again. That's just going to make the prices go up. The solution is prices that reflect incomes or incomes that rise enough to meet the price. Historically, prices move more slowly than our patience, but they do move. Regional differences matter. Sunshine markets that boomed on migration, tourism, and short-term rentals, they're more sensitive to insurance costs, property taxes, and seasonal demand. Tech hub metros are more sensitive to equity compensation and layoffs. Retiree-heavy markets are more sensitive to downsizing waves and estate sales. None of this guarantees a crash everywhere. It does mean that the same mortgage rate can produce very different outcomes in different zip codes. Liquidity matters more in housing than people realize. You can't just click a button and sell a house in 10 seconds. If demand is thin and your home needs work, the discount required to move it can be pretty steep. The homes that still fetch really peak prices in tougher markets, they share three traits. One, they're move-in ready. Two, they're in top school zones or irreplaceable locations. And they're priced correctly on day one. Everything else is negotiation with the calendar, and the calendar always wins. Let us demystify the rent versus buy decision with a clean framework. First, compare total monthly housing costs to a realistic rent for the same quality of home in the same neighborhood. Include principal, interest, taxes, insurance, HOA average, maintenance, and a small reserve for major repairs. Second, quantify the opportunity cost at your down payment. And if you're tying up $100,000 that could reasonably earn, let's say 6% elsewhere, then that's $6,000 a year that you need to add to the cost of owning for a fair comparison. Estimate your horizon. The shorter time horizon, the more closing costs and realtor fees dominate the math. If you're not likely to stay put for at least 7 to 10 years in this environment, renting often wins by a wide margin. Now here's why buying could still make sense. You plan to stay long enough that transaction costs get amortized over a decade or more. You have a strong emergency fund after that down payment. The home is rare enough that you can't rent a comparable one easily. The monthly payment is safe at your current income without assuming a refinance, because that's not guaranteed. And negotiate hard on inspection and price, and you're honest about what you can handle if rates stay where they are for longer than the headlines suggest. When we built our home 3 years ago, everyone kept saying, oh, mortgage rates are going to go down. You can just refinance. It's no big deal. But they've only dropped like 0.5% since then. Now here's where selling still makes sense. You own an older or dated home, competing against builder incentives nearby. You need to move out within the next year, and the math just doesn't work as a rental. Your carrying costs are too high for your risk tolerance. In those cases, speed beats perfection. Price the market you have, not the market that you wish you had. Clean, repair, stage, and price to attract multiple offers in 1 week. Chasing yesterday's comp for 3 months almost always nets you less. Insurance and taxes are silent killers in many regions, especially that Sun Belt. Premiums have jumped and deductibles have changed, and some carriers have left states entirely. Property taxes can reset the purchase price, so the payment that the current owner shows you may be lower than the payment that you'll actually owe. If you're analyzing a deal and ignoring these two line items, you're not analyzing a deal. You're just daydreaming. Now, short-term rentals deserve a blunt paragraph. They're a business, not a coupon for free real estate. If your entire pro forma hinges on perfect occupancy, low cleaning costs, and the same nightly rate that you saw in the boom year, you're setting yourself up for a subsidized vacation home for strangers. Now, if you insist on buying for that purpose, underwrite it like a conservative long-term rental and treat any short-term upside as a bonus, not a necessity, maybe it'll work. Demographics will play a huge role over the next decade. As older owners eventually downsize or pass properties to their heirs, more homes will start to come to market. Some will be dated, and they'll need some capital to bring up to current tastes and modernize them. And that could be a huge opportunity for prepared buyers who have a little bit of money, and a headwind for sellers who wait too darn long. The point's simple. Supply is not frozen forever. Life events thaw it out, and here's a simple 4-step playbook to avoid the biggest mistakes. Step 1, decide if you're payment driven or price driven. If the monthly number must fit in a hard cap, ignore list prices and shop by payments. Step 2, build a total cost of ownership sheet for the exact property you want, and then compare it to renting the same thing down the street. Don't compare a dream house to a bare bones apartment. Apples to apples only. Step 3, negotiate the facts. Use inspection reports, builder incentives, recent price cuts to ask for concessions that matter to your cash flow. Step 4, have an exit plan. If you had to sell in 12 months, could you do it without writing a huge check? If the honest answer is no, the price is too high or the plan's too optimistic. If this helped, drop a comment below with your city and whether renting or buying wins out on a monthly basis right now. Your experience on the ground is worth more than 1,000 think pieces, and it helps other viewers just like you pressure test their own assumptions. Now, here's the bottom line. I don't believe that national home prices are going to collapse everywhere all at once like 2008. I do believe your math favors renting in a growing number of markets until either rates fall materially or prices reset to meet local incomes. If you buy with a decade in mind, not a refinance fantasy. If you sell with speed and realism, not nostalgia. Anyway, thank you so much for watching, and I'll see you next time.